Chapter 16. Long-term, low-management investing. Now that we understand the basics of individual stocks, let's look at the index funds. Index funds are large collections of stocks that you can use to track the health of the overall market. The three largest U.S. index funds are the S&P 500, Dow Jones Industrial Average, and the Nasdaq Composite. These funds have been used for decades to look at the overall performance of the stock market. When you look at these index funds, see if they are weighted or unweighted. All of the aforementioned indices are weighted, which means that some stocks carry a larger percentage of the index's overall balance than others. In an unweighted index fund, all stocks represent the same percentage of the overall index. Differently weighted stocks allow the index funds to more accurately represent the market by giving more value to higher market cap stocks. Market cap weighting is the most popular type of fund weighting because it emphasizes the value of larger, more valuable, and generally more established companies. Sometimes, the unweighted variant of weighted funds may outperform the weighted fund in the long run. For example, the S&P 500 turned $10,000 from May 1st, 2003 to at the time of writing in 2008 into $31,857.16. However, an equally weighted S&P ETF fund turned that same $10,000 investment into $42,685.74. Keep in mind, these metrics completely ignore dividends during the same time period, which average a 2% reinvestable annual gain. While equally weighted funds may expose your portfolio to more upside, remember that you inherently incur greater risk by giving your smallest, most volatile stocks the same weight as your large, stable ones. The S&P 500 index, GSPC, is where we get our 9% number from before we even account for reinvested dividends. The S&P 500 contains 500 or so stocks that may be slightly altered annually by S&P Global Inc. and its subsidiaries. Historically and currently, the S&P covers about 80% of the stock market by market capitalization. The S&P contains some of the largest companies in the market that represent their market sectors, creating a particularly diverse fund. To cover so much of the market, the index exclusively includes companies with large value market caps. This also allows the index to track liquidity and risk in the market's largest companies. The Dow Jones Industrial Average, DJI, or Dow 30, is currently a basket of 30 large, sturdy stocks that cover all industries except transportation and utilities. Ownership of the DJIs moves around a lot historically, and the index is currently supervised by joint effort between S&P Global, the CME Group, and News Corp under the name S&P Dow Jones Indices. This index was started early in the 20th century by Charles Dow, and it originally only had 12 stocks, a number that grew to 20 in 1916 and 30 in 1928. Since then, the stocks in the Dow have changed through recessions, bankruptcies, acquisitions, and component drops thanks to its management firms. The Dow is a price-weighted index, meaning that more expensive per-share stocks account for larger percentages of the total index. The Dow adjusts for splits and reverse splits to account for voluntary changes in companies' share prices. We'll look more at splits in Chapter 23. The Nasdaq Composite, IXIC, is a unique index because its price is based on the entire Nasdaq stock market. The Nasdaq is a market cap-weighted collection of every common stock in the Nasdaq exchange, currently the second largest exchange in the world behind the New York Stock Exchange, NYSE. The Nasdaq came around in the 70s to bring electronic listing services to companies, and most large technology firms and innovative companies are listed on the Nasdaq. The Nasdaq Composite contains thousands of common stocks, limited partnerships, real estate investment trusts, and foreign stock holdings. The number increases every time a new company goes public and gets listed on the exchange. The Nasdaq 100, NDX, is another index that comes from the Nasdaq. This market cap weighted index contains 100 or so components from the largest non-financial companies on the Nasdaq. Both the Nasdaq and Nasdaq 100 are known for the large technology companies that make up a significant chunk of each index. However, the Nasdaq 100 has historically outperformed the Nasdaq Composite significantly, as shown below. And then there's a graph, and you can see on the lower line the Nasdaq, and then the upper line the Nasdaq 100. From highest to lowest return, we see the Nasdaq 100 and the Nasdaq Composite. The NYSE also has an NYSE Composite, NYA, but this index has underperformed the S&P 500 in the past, as shown below. As with the NASDAQ Composite, the NYSE Composite is a collection of thousands of the NYSE listed securities, less its closed-end funds, ETFs, limited partnerships, and derivatives. We will look at these later. From highest to lowest final return, we see the S&P 500, the NYSE, and the NYSE Composite, and that's in the graph above, and just a general separation. Lastly, we get to the Russell 3000, RUA, Russell 2000, RUT, and Russell 1000, RUI indices. These three FTSE Russell managed funds come from the foreign London Stock Exchange Group. The RUA is a market cap weighted collection of 3,000 very large American companies that diversifying investors cherish since the index covers about 98% of the stock market. The RUT is a market cap weighted collection of the lowest 2,000 market cap stocks in the Russell 3000. This fund is used to collectively measure the performance of small and mid cap stocks. The Russell 2000 represents about 8 to 9% of the Russell 3000. The RUI is our last market cap weighted fund that makes up the remaining highest 1,000 market cap companies in the Russell 3000. In contrast to the Dow Jones Industrial Average, which tracks 30 large corporations, the RUI contains a wider, diverse range of large companies. The large cap companies in the Russell 1000 represent about 91 to 92% of the Russell 3000, or 90% of the overall stock market by capitalization. Despite their differences, all three Russell indices perform relatively similarly as they track market conditions, as shown below. Then we see the graph, and it's pretty similar for all three. From highest to lowest return to the mid-2008 peak, just before the final downtrend shown in the chart, we see the Russell 2000, the Russell 1000, and Russell 3000 indices. So the Russell 2000 just varied a little bit more than other ones. The only index to seriously deviate from the Russell 3000 above is the Russell 2000. Here's a chart that looks at the historical performances of the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, and Russell 3000 from 1985 to 2008. Then we see the long-term compounding growth chart where they just go up over time. In the long run, you can see the NASDAQ is the highest performer overall, and also the biggest one to bust in really crash after the 2001 financial crisis with the dot-com bubble. From highest to lowest final return, we see the NASDAQ Composite, Dow Jones Industrial Average, Russell 3000, and S&P 500. Notice that all of these indices recover from their downturns and pull out to make you more money in the long term. Even if you encounter a short-term pullback, you can expect your money to recover and grow its value in the end. Remember, do not make overly emotional buying or selling decisions in large economic uptrends or downtrends. It is always darkest before the dawn. With the S&P slumping as our lowest performer, we see that there are certainly ways to beat the average S&P market return while still investing only in large, diversified, less risky indices. I put average in quotes because you should never limit your investing mentality. Never tell yourself a limit on how much you can make. You can make as much money as you want in the market as long as you put enough time to learn the technicals, practice trading, and research constantly. Remember, you will constantly put money into the market as a long-term investor saving for retirement. So you should care less about short-term quick price swings. Your average fill price will average out as you add more shares to your portfolio at different times. However, you should still watch out for immediate market shifts that represent an overall downturn in the economy. For example, we see the 2001 dot-com bubble particularly well in the NASDAQ, alongside the 2008 subprime mortgage housing market crisis and Madoff investment scandal in all these major index funds. Index fund tracks the holistic performance of our economy. In a way, they are our economy. Indices are the most diversified and least time-consuming way to invest in the stock market because they are just large corporations of large groups of hard-working companies. The index funds are foundational baseline of many retirement plans because they are generally known as the least risky way to invest in the stock market. Crashes in the overall market happen, and we will look at how to forecast them in Chapter 22. All investors should eventually expect large institutions or shareholders to liquidate their holdings in any given stock or overall market, driving prices downward. Remember that stock prices are largely dictated by public opinion, buying pressure, and selling demands in the short term. Stick with your own solid long-term picks that you know will continue making money when other shareholders cash out their positions. It is almost impossible to time overall market pullbacks because they only happen when widespread public perception of the market changes. To keep your returns high, worry about long-term stock performance and adapt to market trends when they rise, carefully watching out for any glaring market issues. If your research shows that a stock is poised to temporarily drop, never be afraid to act on your knowledge and take gains. Additionally, you can adapt short selling into your trading to profit from a market drop. The S&P 500 in particular, with its conservative 7% post-inflation average long-term capital gains, is a true summary of American business. This low-risk index also led to the creation of the 4% rule among financial planners. The principle behind the 4% rule is that you can withdraw 4% of your stock portfolio in retirement and still have an average long-term return of 3% in up and down markets. If you can cover your annual expenses with 4% of your investment's combined value, then many financial planners will tell you that you can retire. You can use this principle to estimate how much you need to retire based on your current consumption habits.